Hello, I'm Sabina, CPA. I advocate less taxes and more profits. Today, I'd like to talk about 6 ways to tame your capital gain tax bite. A cornerstone of smart tax planning is year-round management of your property sales and purchases. And the key component of this activity is knowing what the resulting sale of a home, stock, or collectible creates a taxable gain or loss with varying tax implications. The savvy taxpayer understands that the correct capital gain approach can save plenty of money. And I'm going to discuss 6 capital gain tax cutting opportunities to consider throughout the year. Number 1, take advantage of lower long-term capital gain rates. Assets sold that were held for more than 1 year and 1 day benefit from advantage tax rate. Instead of paying ordinary tax rate as high as 37%, you get a lower rate of 0 to 20% depending on your income. When selling an asset, first check when it was purchased to see if waiting a little will push it over the 1 year and 1 day mark. Secondly, wisely harvest short-term losses. Since capital gains are taxed at different rates, the IRS requires that capital losses are first applied to any losses from the same category. For example, long-term losses are initially netted against long-term gain. Any excess loss can then be applied to short-term gain and up to $3,000 of ordinary income. Take advantage of this rule by trying to match any losses against short-term gain and ordinary income whenever possible. Thirdly, watch out for the special collectible tax rate. Certain items worth collecting can get taxed at an even higher rate of 28% when you sell them. Some examples include valuable paintings, trading cards, or rare coins. If you plan to sell a collectible item, first track your basis, which is original price plus fees you pay for the item, to ensure an accurate gain amount can be calculated. Next, check your marginal tax rate. If it's lower than 28%, selling an unwanted collectible before you've owned it for 1 year and a day can result in a smaller tax bite. Fourthly, treat cryptocurrency as an investment. The IRS certainly does. Every exchange of cryptocurrency like Bitcoin has a component of gain or losses that must be tracked. This includes using the cryptocurrency to buy something or just the act of trading the currency on an exchange. All these transactions need to be reported on your tax return and recorded as a capital gain or losses. Fifth thing to know is to know the primary residence capital gain exclusion. One of the best tax break going is the $250,000 or $500,000 if you're married, primary residence gain exclusion. But misunderstanding the rule can cost you. It's especially important to understand the length of time you have owned the property and when your property can be treated as your primary residence. Other situations that can cause troubles are going from 2 homes to 1, often experienced by newlyweds, or selling a home after a divorce. Lastly, leverage gains with charitable giving. Consider donating property with a long-term capital gain to a qualified charity. If the donation meets certain rules, not only will you avoid paying capital gain tax, you will receive a tax deduction equal to the higher fair market value of the property donated. With so many rules and constantly moving pieces, it's important to consider the tax consequences with every investment or property transactions. This is an exercise the savvy taxpayer is conducting throughout the year. If you find this video useful, please click on like, subscribe, and forward to those who may also benefit from this tutorial. Please also head to basecpaplus.com to sign up for our email newsletter full of tips for less taxes and more profits. Until next time, God bless.